Hey, let's take a look at what happens when a client asks whether or not they should put extra money towards the principal of their loan. And this happens quite a bit. There are some people that have a specific strategy in mind and they want to pay that loan down as quick as they can. But the average length of a mortgage in the United States is only about 7 years. So throwing money towards the principal of your loan to pay the balance down when we can count on natural appreciation to create that same equity position doesn't make sense if you have additional debt, say a car loan or a credit card that needs to be paid off, or if you'd rather just pad your own pockets and put that same amount of money in the bank. So let's just take a quick look here. If we go into the more info section of our total cost analysis and we click on reinvestment, we can see that on a $450,000 loan, the principal and interest payment is about $3,400 a month. Well, if we take that $3,400 and divide it by 12, it means we would be able to put an extra $284 a month towards the principal of the loan, which would effectively reduce that loan by about 7 years, maybe a little bit more. And it would drive over a 5-year period that loan balance down to $363,000. If we took that same $284 a month and we paid ourselves, instead of putting it towards the mortgage over that same 5-year period, you've accumulated about $17,000 into a savings account, assuming that you can get 0.5% from a local bank. Now, if you took that money and got more creative with it through a financial advisor, they can probably do some things that are a little bit more extravagant. But my point is, it doesn't make sense to throw money towards the balance of your loan if you want to also save cash, because once you put the money towards the balance of the loan, you can't get that out unless you sell the house or refinance it or take out some kind of home equity line of credit. Let's look at the implications on the equity scale here. If we go down and assume you have this loan for 5 years, in 5 years, the balance of your loan is $363,000 versus if you just make normal payments and put the money in the bank, you're at $383,000. So you've got about a $20,000 less balance in 5 years on your mortgage. But remember, you've also got about $17,000 cash in the bank. So weigh your options. Decide which one makes most sense for you, whether you want to win the contest of saying that you have your mortgage paid off sooner, or you'd like to be able to say that you've got some money in the bank for a rainy day. And if you have any questions at all, you can reach out at andyloan.com. Have a great day.